Index funds are passive investments that many people are using, and the increasing popularity of these passive investments might be turning into the next big bubble that will be catastrophic if it bursts. In this video, we're going to go over what an index fund is, how an index fund allocates their money, and how index funds are becoming a bubble. Before we begin, don't forget to like and subscribe to support the channel. Index funds have become the go-to investment for many people. And why not? They are super easy. You can just set it and forget it, and you really don't have to worry about your investment on a day-to-day basis. Also, they have very little fees compared to an actively managed fund. A Vanguard S&P 500 fund has an expense ratio of just 0.03%, and an actively managed hedge fund can have a 2% fee, plus a fee on the money that they make you. This is why index funds have become so popular. It is super easy for everyday people to get into them and invest in the stock market with these low-fee index funds. The overall payout of these index funds usually beat out an actively run hedge fund as well. To test this, Warren Buffett made a $1 million bet with protege partners that they could not put together a portfolio of hedge funds that would outperform an S&P 500 index fund over a 10-year period. Buffett was convinced that the combination of active stock picking and high costs would result in lagging market performance. After the 10 years were up, the Vanguard index fund that Buffett chose was up 85.4%, while the hedge fund portfolio was only up 22%. This is why people are flocking to index funds, because they just seem to work and are cheap and easy to invest into. In 2009, active funds had nearly 3 times more assets under management than passive funds. 2019 was the first year passive funds overtook active funds by market share, with more than $4.2 trillion invested in these low-fee index funds. Another big reason index funds took off in popularity is that a lot of 401ks and retirement plans offer index funds now instead of actively managed funds. This is a lot of money flowing into these funds and out of actively managed funds. So how do index funds actually allocate all of their money? Is it just spread evenly between the companies in the fund? Well, what actually happens is that each company is weighted based on market cap. The top 5 biggest companies in the S&P 500, which are Apple, Microsoft, Amazon, Facebook, and Google, make up 20% of the overall value of the S&P 500. So for example, if you invest $100 in the S&P 500, you are putting $6.45 into Apple, $5.50 into Microsoft, $4.48 into Amazon, and so on. So your money does get spread out between companies, but the more the company is valued, the more money your $100 gets invested into them. Also, companies can be taken out of the S&P 500 and also brought into the S&P 500. We recently saw this with Tesla and Etsy, which both got brought into the S&P 500. Now, every time you invest in an S&P 500 index fund, you will be investing in these companies as well. So what is the big issue with investing in these funds? And how is it possibly creating the next big bubble? Well, according to Michael Burry, that predicted the 2008 housing crisis and bet against collateralized debt obligations, he says that one big problem from investing in index funds is that there's no more price discovery. What he means by this is that if there are trillions of dollars flooding into these index funds, and they all invest in the same companies, those companies' prices start to not actually reflect the actual value of the company. If bad news about the company comes out, it doesn't really matter. The money is still going to be flowing in since people are buying index funds. This makes the whole market more overvalued, and it becomes harder for people to actually find good undervalued companies. Also, people become more complacent in their investing, and in this way, the market becomes less informed about these companies and what they are actually investing in. A majority of people who invest in these funds probably don't know the companies they are actually investing into, past the first maybe 10 companies on the list. Little do they know they are investing in tobacco companies like Philip Morris or other companies that may soon be going obsolete in the next 30 years if they don't pivot and adapt to new times. Eventually, the companies in these indexes become so overvalued that the juice isn't worth the squeeze anymore, and all the money dries up. If this happens, then instead of inflowing money, there will be a big outflow of money, which could lead to a liquidity issue in these funds. In an interview with Bloomberg, Burry states that 266 of the 500 stocks in the S&P 500 had less than $150 million in trading volume that day. That sounds like a lot, but trillions of dollars in these assets globally are indexed to these stocks. The theater keeps getting more crowded, but the exit door is staying the same size. He also stated that if you look into the Russell 2000 index, if it wasn't for money coming in from index funds, more than half of those companies would basically die because their funding would stop. This is because they would no longer be able to issue new shares as their stock price wouldn't move, but nobody would be looking to buy. Other people also have sounded the alarm on investing in index funds. Cathie Wood from ARK Invest, who has become more popular because of her pre-split price target of $7,000 on Tesla, has also come out and said that investing in index funds is like investing in the past, and investors should be focusing on investing in the new world. She says that indexing used to be a very good strategy, but now a majority of companies are not adapting fast enough to changing times, and a lot of them are going to get left behind. She believes that people should be investing in companies that are disrupting markets and innovating. This makes sense since a majority of her investments are in the tech sector. It is always good to know where your money is going when you invest it, and maybe index fund investing isn't the best way to do that. Sure, it is super easy, and it is good because more people are starting to invest. However, there are definitely some downsides of index fund investing. There is a massive amount of your money that is misallocated into companies that you probably wouldn't want to invest in. That is why I think it is better to look at the list of the S&P 500 and pick your favorite stocks that you think are going to do well. Also, invest in companies that you use every day, and invest in companies that you understand and know. If you use a product or service every day and enjoy using it, chances are that you are not the only one. Also today, information about these companies is readily available and easy to get for anybody. That is why I think it is always great, if you can, to start making your own portfolio and start moving more money away from index funds and into investments that you made yourself. At the end of the day, is index fund creating a massive bubble? Maybe, maybe not. Both Michael Burry and Cathie Wood run hedge funds, so it is fair that they don't want people investing in index funds. But they do bring up some good points, and it is a good reminder to always do your homework before investing in anything, and to make sure you always know where your money is going. And with that being said, as always, thanks for watching, and like and subscribe to see more videos.